Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look not only outside of the S&P 500 at other stock indexes and sectors, we also look at other markets because no market exists in a vacuum. And so sometimes we can get some insight or clues as to what's happening when we look outside of the S&P 500 and even outside of the stock market. This is being prepared for Monday, December 4th. The first area that we look at is S&P 500 valuation. We look historically to see what our current price is right now based on historical valuation levels. And then we can also look forward as to what does the market think the valuation would be looking into the future. The first area that we look at is called the PE ratio, and this is on a static scale of 10, 15, and 20. When we're at 20 or above, either the index or a stock is considered to be expensive. At 15, it's fairly valued. At 10, it's considered to be inexpensive or cheap. We can see looking at the black line, that's the S&P in relation to the red line, which is the PE ratio of 20. Then down on the bottom, this is the spread between the two. Whenever we're above 0, that means that we are expensive. So on a historical basis, we continue to be expensive, but we've been that way for quite a while. So this is not necessarily a surprise. We just want to be aware of this. We can also look at valuations in the context of different historical events, showing that what the valuations were at that time. Then we also look at a little different way to calculate this called the Shiller PE ratio. This takes more of an average over a period of time. Way over on the right, we have a current reading of 31.10. To give us some context, we can look at the chart to see what were other valuations at that time. And we can also look at the median and the mean, and we're between 16 and 17. So looking historically with this more averaged approach, we are also considered to be expensive. But the market doesn't do that. They like to look forward. So based on analyst projections and forecasts, we look at the S&P 500 forward-looking PE ratio, which as of Friday's close is at 18.9. So we're above the 15 level of fairly valued, but we're below the 20 level, which would be considered to be expensive. Just to get a little more context, we look at the mid caps where we're coming in at 13.9. So we're under that 15 level. And the small caps are at 13.2, also under that 15 level. We can plot all of these together on one chart, put them in different colors just to get some context here, and they really have a tendency to move in the same general direction. One area that we do look at are the small caps, and there are two different main indexes. There's the S&P 500, S&P 600, that's the small cap index, and then we have the Russell 2000. I tend to follow the blue line because that fits on the 10, 15, 20 scale. Another popular index is the Russell 2000. That's the red line, and it's on a slightly different scale. We do look at growth versus value. Growth is when you want to buy low and sell high. Value is when maybe you're more interested in dividends or stocks that tend to hold up better when the market's running into some difficulties. So we look at just a pure growth index, and even though it's been coming back lately, we're continuing to be in an overall downtrend just with growth. We're also in a downtrend when we look at value, but it has also been showing some improvement. Where this gets most interesting is when we do ratios between the two. And even though growth is in an uptrend, meaning that it's outperforming value, it has been declining lately, where value has been underperforming growth, and it has been improving. The reason why we look at a number of different indexes and ETFs is they're all calculated in a slightly different way. You can see that the difference is just a few days here when the moving average crossover occurred. But if you are shifting from one approach to another, you want to have lots of confirmation. We also look at an ETF showing how growth has been outperforming value, but it has been falling back. Here's an inverse showing how value has been underperforming growth, but has been improving. Then we look at some other indexes longer term where growth is outperforming value, but pulling back. And then this shows where value is underperforming growth, but has been improving. So we're seeing some confirmation. We also look at another index, a little shorter term here, where growth has been outperforming, but pulling back recently. We look at another measure of growth to value, and this has been holding up a bit better. We were actually breaking out above these previous levels, but we have been pulling back. Here's an inverse of that same chart showing how value's been underperforming, but starting to bounce back up. So when we take all of this together in the bigger context, yes, growth is outperforming value, but lately growth has been really underperforming in the shorter term. We also look at the small cap growth to value index, and I show this quite often in the daily videos where we've been chopping more or less sideways. Even as the index has been coming down, this has been holding up. But on Friday, small caps really shot to the upside, where we actually saw the growth to value ratio going down. We also keep an eye on the mid caps, which they've been holding up fairly well, even as the index was under pressure. But the same thing, we saw a really solid up day with the mid caps, and this ratio ended up declining. This is a bit of a concern. This is S&P 500 growth to value. And with the S&P going up the way it has been, we want to see this ratio going up. It's actually been going down. So we just want to be aware of this, because in a more solid environment, we want to see growth outperforming value. We keep an eye on inflation. This is a monthly chart of the CRB, which has been going more or less sideways. It's coming back down to its moving average. Then we look at inflation versus deflation areas of the CRB index and take a ratio where this is turning back up just a little bit, but it's still below the moving average. When this was declining, that was giving us a little bit of concern, because that could be more deflationary, which is actually worse than inflation. The fact that this is turning up but not really getting all that strong yet is making this a little more comfortable. We look at the CRB index, which is in an overall uptrend, but it has been pulling back recently. We look at the Baltic Dry Index. This is what does it cost to ship products from one place to another place, specifically in the Baltics. And there are folks that shift forward and place other indexes on top of this and try to get some insight that way. I just look at the S&P on top and the Baltic Dry Index on bottom, and this is really starting to shoot up, which could be inflationary. Typically, as these prices are going up, that means that these companies are charging more to ship things. Some other markets that we just look at just to have an idea where we're at. This is aluminum, which continues to be in a downtrend. Corn is also in a downtrend. Wheat continues to be in a downtrend. We look at fertilizer. That's a pretty important part of growing crops, and that has been declining lately. We keep an eye on oil, which has been chopping around. It's been a lot in the news lately. We did get up to 95. We started to drop back down into about the mid-70s. So for right now, this continues to be in a downtrend after having been in a pretty solid uptrend. Gas, which impacts everybody who has to fill their car or truck, it continues to be in a downtrend. We look at diesel, again, something that can be passed on in the form of inflation, where lately it has been coming down. We look at heating oil. It's also been coming down, but it's still in a longer-term uptrend. Natural gas, also, it really fell, started to come back up, and is now starting to go back down, still in a longer-term downtrend. We look at copper. This is more of a barometer of the economy. When it's going up, that means that looking forward, folks tend to be more optimistic about the economy, where it continues to be in a downtrend here on the daily chart, but it has been bouncing back up, but not enough yet to get into an uptrend. We look at the copper to gold ratio. Copper tries to measure the economy. Gold is more like a fear gauge. And we can see that copper has been underperforming gold, but it has been bouncing back up lately. Here's a longer term look at that same chart. Here's the black line going all the way back to 1980. That's the copper to gold ratio. We also plot the 2-year yield in green and the 10-year yield in red, where in other environments, we tend to see them go in the same direction. And even though they're on different scales, they have a tendency to not get all that far apart. The last couple of years, there's been a really wide spread between all three of these, as the economy may be shifting into more of a new type of dynamic. But we won't know that until we see the bigger picture more in context. Gold is just about ready to go back into an uptrend. We really are starting to see this break out. It does have some previous highs that it's been dealing with. It had been really going down. It started to go up when everything erupted in Israel. Then it fell back a little bit, and now it's starting to go up again. where silver is also showing some improvement, but it's still in a longer-term downtrend. We look at the closing value of gold on top where it's been breaking out. We also have silver in the middle. Then on the bottom, we look at the correlation between the two, and they have a strong tendency to go in the same direction. It can be up or down, but they tend to move in tandem with each other. At least recently they have. Then we have a different kind of study to look at. It's the gold to silver ratio on top. When this is going up, that means gold's outperforming. When this is going down, that means silver is outperforming. And then in the middle, we can plot the US dollar index, and we can see on the bottom that there's a pretty strong correlation between the two. So some general observations are when the US dollar index is going up, gold tends to outperform silver. When the US dollar index is going down, silver tends to outperform gold. If this is not a market that I really deal with in the videos that I produce, but if you are into precious metals, this might help you as to how to position things during different times. We keep an eye on the dollar, which is in a longer-term uptrend, but it has been pulling back over the last few weeks. Excuse me. Then we look at the dollar in relation to the euro, where the euro has been seeing some strength against the dollar. And we also keep an eye on the Japanese yen, which continues to show weakness compared to the dollar. Then I have some individual charts. Here's the euro to the dollar, which is still in a downtrend, even though the euro has been bouncing back. The Japanese yen is still underperforming the US dollar. And the British pound is still in a downtrend when compared to the dollar, but has been bouncing back up as we've been seeing some weakness in the dollar. We keep an eye on some different indexes. I usually show this in every daily video. The red line here is the equal weight index, where it treats all stocks the same, where the S&P 500 itself is a weighted index, so the really big companies have more of an impact. When the red line is underneath the black bar chart, that means that the broad market is underperforming, even though they're on different scales. But we are seeing some improvement with the equal weight index, as we're seeing a little bit of an improvement as the broader market is participating in the upward move that we've seen over the last few trading sessions. We keep a ratio of the S&P 500 to the CRB index, showing how the S&P is outperforming. It's still in a downtrend, but if we stay above this, we could end up crossing over positive, as stocks have been showing some improvement. Here's an inverse of that same chart, where the CRB is still in an uptrend compared to the S&P, but it has been declining overall. We look at the NASDAQ 100, which has been doing well, and the S&P 500, which has been doing well. And this is just showing that the NASDAQ 100 has been outperforming the S&P 500. The S&P 100 actually fell back just a little bit, but it's still been outperforming in the longer term when compared to the rest of the S&P. The NASDAQ, which has been doing well, compared to the S&P 500 ratio, it's been chopping more or less sideways, but just showing that the NASDAQ is outperforming. We look at the NASDAQ 100 and the NASDAQ, which both have had really good years in 2023, showing that the NASDAQ 100 is outperforming the NASDAQ. Then we look at the mega caps. Those are the real big monster companies that typically everybody's heard about. And we compare it to the equal weight ratio for the S&P. And this continues to show that even though they're falling back over the last few trading sessions, the big mega caps have been outperforming. We look at the small caps and take a ratio to the S&P 500. That's the red line. And this is starting to turn back up. And we want to see this going back up, and that often gives good support to the S&P, which is the blue line on this chart. Then we look at another ratio between small caps and the S&P, where it's bouncing back up, but in the longer term, for most of 2023, the small caps have been underperforming. We look at the biggest software companies. They're still in a downtrend, but they have been bouncing back up. If we can stay above these lines, we might see a golden cross. The mega caps, those have been the real story stocks in 2023. They continue to do quite well. We look at the robotics and AI ETF, which is showing some improvement lately. But when you look at it compared to the tech sector, it has been really underperforming, even though now it's starting to bounce back. The Dow Jones Composite Average takes the Dow, the transports, and the utilities and puts them together. We are seeing some improvement here, but we're still in a longer-term downtrend. Then we compare the S&P 500 with shorter-term bonds going from 1 to 3 years. This suggests that on a shorter-term basis, stocks have been outperforming bonds. Then we look at the broad market and showing that stocks are outperforming bonds when we look at the 3 to 7 year bond ETF. The low volatility stocks are showing some improvement, but still continue to be in a downtrend. And for most of 2023, when we do a ratio, the low volatility stocks have been underperforming the S&P. We look at the tech sector, which is outperforming the 3 to 7 year bond ETF, even though it's been pulling back lately. And then we compare this with other stocks. We look at an advanced decline line study with the NYSE, and I show this pretty much in every daily video where we're seeing some improvement. We're also seeing an improvement with the S&P, the mid caps, and one area that's been quite weak are the small caps, and they're actually getting back above their moving average with their advanced decline line. We look at Dow theory, which the Dow had a pretty good week. It's really starting to shoot up. The transports were up, but they are underperforming, and I'll show you that in some other charts. The utilities have been under a lot of pressure as interest rates were going up. Now, as interest rates have been coming back down, we're seeing some improvement with the utilities. Here's a ratio between the transports and the S&P. We did see it really move up in Friday's session, but we want to see more follow through here. Longer term, the transports have been underperforming, and when the transports do well, that tends to give good support to the S&P. We look at the Dow to transports ratio. When this is going up, that means the Dow is outperforming. When this is going down, that means the transports are outperforming, and we've been chopping up and down recently. Then we look at the relationship between the S&P 500 on top and the transports, and it was getting to the point where they were almost going in opposite directions of each other, but we are seeing this relationship or correlation show some improvement. We look at a new take on Dow theory, where instead of using the Dow on top, we use the S&P. Instead of using the transports, we use the NASDAQ. That tends to be a better representation of the current U.S. economy, where we're coming back up to this previous high and actually closed a little bit above it with the S&P. We haven't quite broken out yet with the NASDAQ. So this is a little bit of a negative divergence here. If we do see some improvement, it would take care of that divergence, especially for the NASDAQ. We look at the FANG index, which has been doing quite well and going up nicely, but lately it's been chopping more or less sideways, but it's still in an uptrend. We've been dealing with this all-time high here. We've been coming back up. Sometimes we break through it on an intraday basis, but we're having a really difficult time closing to a new all-time high. ARK, a very popular ETF that a lot of folks get into, it's still in a downtrend, but it has been bouncing back up as stocks have been doing well lately. Then we look at a longer-term chart, a monthly chart of a ratio between the S&P 500 and international stocks that are based in Europe, Australia, Asia, and the Far East. It's showing that the S&P is outperforming or above an advancing moving average. We look at the momentum where it's turning over just a little bit, but we're still above zero in the long term. We look at stocks versus bonds, where based on price, bonds continue to be in a downtrend, but they have been bouncing back up. We look at a world bond index where it's also in a downtrend, but is showing some improvement. We look at a stock to bond ratio on a monthly chart. Even though this is rolling over slightly, stocks are still outperforming bonds. On a shorter term basis, this is showing how bonds are underperforming stocks. Then we look at high yield corporate bonds, which are junk bonds, and they tend to follow more with what the stock market does. And the stock market's been doing well lately, so we're seeing junk bonds doing well. We look at investment grade bonds, which are more conservative. They continue to be in a downtrend, but they have been showing some improvement. We look at a ratio between riskier bonds like junk bonds and more conservative bonds like government bonds, and folks are still preferring to be in the riskier bonds. They're willing to take on the added risk because they get a better return on that than getting into more safe government bonds that aren't giving as high of a yield. We look at a correlation between stocks and bonds. They're having a fairly strong tendency to go in the same direction. So if stocks based on price are going up, then bonds based on price are probably also going up as well. We look at the Dow Jones Corporate Bond Index, which is still in a longer-term downtrend, but it has been showing some improvement. We look at the 10-year yield, where we're coming back down to this 100% retracement level. We got almost up to 5%, didn't stay there for very long, and we have been declining lately. This is a longer-term look at the 10-year yield, where we've been seeing a series of lower highs and lower lows as the interest rate environment was becoming lower and lower. Now we're breaking out longer term, and we're wondering, are we going into the old new norm where interest rates tend to be higher than what they've been over the last 40 years or so. We look at the 30-year yield just to keep an eye on that. The 10-year is what we focus on the most, but we also want to keep an eye on the 30-year yield. And then we look at a ratio between the S&P 500 and the rise or fall in interest rates. When this is going up, that means that the S&P is outperforming, but longer term, it's still continuing to underperform. Here's the junk bond ETF, which continues to hold up rather well. And we look at a ratio between junk bonds and government bonds, showing how junk bonds have been outperforming, even though this ratio has been pulling back lately. Here's the 7 to 10-year Treasury bond based on price, where in the shorter term, the MACD continues to be positive, but longer term, we're working off of a negative trend. The RSI is above 50 and advancing. So this, in the bigger picture, is still negative, but it has been showing some improvement in the shorter term. Here are the Treasury yields, which had been going up across the board. Now we're starting to see them come back down, and that's giving some good support to stocks. Here's a weekly chart internationally showing that the US and UK have the highest rates. In blue is Germany, and in red is Japan. On the top, we have the thing called the MOVE Index, which measures the volatility of bonds, and the volatility has been coming down more or less. And we look at the VIX, which measures the volatility of stocks, and that has been really going a lot lower too. The VIX is very popular to keep an eye on, and we look at the correlation between the two, where they have a pretty strong tendency to go in the same direction. We look at a monthly chart of the 10-year price of the Treasury, where it has been in a longer-term downtrend, even though it's been bouncing back up. When we look at a ratio of the price of the 30-year bond and compare it to the CRB index, this is suggesting that the 30-year bond is still outperforming, but this is a long-term chart that can take some time to actually change. We look at the S&P in different sectors, where on top is the S&P, on the bottom is a ratio between the material sector and the S&P, showing how materials are underperforming even though they've been bouncing back. Communication has been a stronger area in 2023, and it's outperforming the S&P. The energy sector has been all over the place, where it looked like it was really starting to improve. Now it's continuing to show more weakness, even though it did have a golden cross here. The longer we stay below this, the more this blue line may come down and cross below the red line. The financials, which really got hit last March and have been going sideways, they're finally starting to break out above their 200-day moving average when compared to the S&P. The industrials also showing some recent bounce action here, but longer term continue to be underperforming. The tech sector pulling back a little bit, but continues to outperform the S&P. And staples have been rather weak in 2023, and they continue to underperform. Real estate also seeing a little bit of bounce back here, but longer term, they continue to be underperforming the S&P. Utilities also continue to underperform. Here's the S&P to utilities ratio. When this is going up, typically the S&P is going up. When this ratio is going down, typically the S&P is going down. We've been chopping more or less up and down lately, so this hasn't been all that helpful. Healthcare, which is another defensive area, this continues to underperform the S&P. And here's another look showing how the healthcare sector is underperforming. Discretionary, which has been a stronger area until we got about halfway through 2023, we're actually starting to go sideways, and we're getting ready to see what could be a death cross here with the ratio between discretionary and the S&P. The staples sector, which was under a lot of weakness, has been bouncing back, but is still in a longer-term downtrend. The tech sector has been one of the stronger areas in 2023 and is still in an uptrend. The semiconductors are also showing some improvement and are still in an uptrend. The tech to S&P 500 ratio shows that tech is outperforming. Energy, which was making a comeback here, is now back to underperforming the tech sector. And when we compare growth to bonds, this is suggesting that growth stocks are still outperforming, even though they've been underperforming as of late. We look at the tech sector and compare it with the 10-year Treasury yield, which it has been bouncing up, but it's still in a longer-term downtrend. And here's the 10-year, which is interest rates have been going up compared to the tech sector, but lately it's been falling back. Discretionary to staples, this is another way of looking at growth versus value. When discretionary outperforms, that tends to help the markets better and discretionary is continuing to outperform the staples. And here's an inverse of that same chart, how staples are underperforming discretionary. Gold, which is starting to resume an uptrend here, is still having a difficult time when compared to the S&P 500. It is showing a bit of an improvement here when we have the ratio between gold and the dollar. It is starting to break out, but gold is seeing some strength as the dollar has been pulling back, but we're not back up to this blue trend line yet. High leverage loans continue to hold up quite well, which suggests looking forward that folks still have confidence in the economy. The NYSE composite has been showing some improvement, but is still in a downtrend. Looking internationally at all stocks, we are still in an uptrend and showing some improvement. Emerging markets continue to be in a downtrend, but they have been bouncing up a bit. Micro caps are back above 100, even though they're still in a longer-term downtrend. And we look at the home builders ETF. On top is the S&P. The home builders ETF is in the middle. We look at the ratio between the two, and they have a pretty strong correlated relationship after it had become a little disconnected with each other, but they're both having a tendency to go in the same direction now. Bitcoin, which is back into an uptrend mode, and we're getting up into the 39,000 range, possibly hitting the 40,000 range. It's really been chopping more or less sideways, but as we hit some positive seasonality, we've been seeing some improvement. We look internationally, we see where China's starting to roll over as our emerging markets, but Europe is still in an uptrend, Japan's in an uptrend, and the US continues to be in an uptrend. We look at an intermarket analysis chart going back to the beginning of the year. The black line are stocks, they're doing the best, followed by gold and the dollar, where oil has now gone negative. Bonds are showing some improvement based on price, but they're still negative. Then different correlations. We're getting back to the neutral point between the S&P 500 and the dollar index. They have been having a pretty strong tendency to go in opposite directions. As this comes back up into this other area where there's a red line, a dashed line, and a blue line, that's more of a neutral relationship. And we're dropping back down just a little bit between the S&P 500 and oil, where they're having a slight tendency to go in opposite directions. We look at the S&P 500 and compare it to the 10-year yield, also slight tendency to go in opposite directions. And the tech sector, also slight tendency to go in opposite directions. So if the tech sector and the S&P are doing well, chances are interest rates are probably going down. We look at the shorter term 2-year yield, where they're having a pretty strong tendency to go in opposite directions. Then we look at some long-term studies. This is an NYSE monthly chart where we are still showing some improvement here. We're going above the moving average, and on a momentum basis, we are looking more positive. Then we look at a daily chart, and then we look at the NYSE record high percent index. When this is going up, that tends to be positive. We look at the S&P with another momentum oscillator longer term, where it's starting to show some improvement. And then we look at the S&P on the top, and then we take a ratio between the S&P and the CRB index, which even though the CRB index has been in an uptrend, longer term stocks are still outperforming. We look at a monthly chart of the S&P and then another global index. This is a ratio on top showing that the S&P is outperforming. We're still negative here with the KST, another momentum oscillator, but we are potentially seeing some improvement. Then at the very end, I go through and I list all the things that are positive and those things that are negative. My definition of positive is when the 50-period moving average is above the 200-period moving average. So we have the CRB index, the dollar, gold is now, that's a new addition to the list. The mega caps, the FANG index, bonds, when you look at the high yield and junk bonds, the riskier bonds, tech and the semiconductors, high leverage loans, the Dow, which is starting to move a little bit more. We had a very short-term death cross with the Dow, but since the Dow's been bouncing back up, it's turned back into a golden cross. The NASDAQ and NASDAQ 100, all stocks, and then Bitcoin. All of these are in uptrends according to how I measure them. Then we look at the negative things. This is when the 50-period moving average is below the 200-period moving average. We have the growth indexes and the value indexes. But when you compare the two, growth still is outperforming value. Silver is still in a downtrend, even though it's been improving. Copper is still in a downtrend, but improving. The Japanese yen, The euro and the British pound are still in downtrends compared to the US dollar, but they have been showing some shorter term recoveries. The dynamic software index, those are the biggest software companies. They're still in a downtrend, but they've been bouncing back up. The Dow Jones Composite Average, the low volatility ETF, ARC, is still in a longer term downtrend. The NYSE Composite, Staples, the Total Bond ETF, World Bonds, and then the mid caps, small caps, and micro caps. Even though they had a monster up day on Friday, now we need to see, are they going to follow through? And then emerging markets are still in an overall downtrend, the investment grade bonds as well as corporate bonds. So thank you. I really hope you found this helpful. Please feel free to check out the daily videos that I post as well as the weekly video that I post. The very last video that I do each week is called the deep dive video, where I go through a lot of the charts that I didn't really talk about all that much in the daily videos, because sometimes we can get some insight from that. I hope you have a really nice weekend, and I will talk to you in the next video.